I'm here this afternoon with Kiran Morzaria, Chief Executive of AIM and OTC listed Cadence Minerals, Epicode KDNC, a mining investment company with a portfolio of assets in South America, Europe and Australia, and these include iron ore, lithium and rare earths. Kiran, it's good to speak to you.
Good to see you again, Alan.
Okay, before we discuss the Amapa flagship project, which everyone's talking about, in regard to its investments, Cadence owns 16% of the Cinovec Lithium project on the Czech-German border, 3% of Macarthur Minerals, that's iron ore and base metals in Australia. You have a JV, a Lithium JV with Bacanora, Mexico, and a JV with Yangibana, in Australia with Hastings Technology Metals. Can you give a quick overview of each one and the potential value for Cadence?
Yeah, absolutely, Alan. So as you pointed out, those assets are in the lithium and rare earth and iron ore assets. I think I'll just focus firstly on the lithium and the rare earth assets. I think these are really important assets. Two of them, the European Metals Holding one and Bacanora, are some of the largest hard rock deposits in terms of lithium carbonate, lithium hydroxide in the world. European Metals Holdings, the total resource size is around 7 million tons of lithium carbonate equivalent. They have, and their operating costs is in the lower quartile. The NPV of the project is around the $1 billion mark after tax economics. So we also have a stake in Bacanora, the JV, which is going to be mined in years 7 and 8. Again, that's a massive deposit, 8.8 million tons. Again, lower cost quartile, and post-tax economics of 840 million. So those two projects are very advanced. They're in either complete their pre-feasibility study or embarking on their feasibility study or completed their feasibility study. So they're basically in the advanced stages of the development curve. That's really important to us. It's de-risk, and there's potential value, a huge potential value for us there. We also have a stake in Macarthur Minerals, a small stake, 3%. That is really an iron ore asset embarking on its feasibility study. And we also have Yangibana, a rare earth deposit, which produces primarily neodymium. Neodymium is used in the permanent magnets of electric vehicles. So within Sonora and European Metals, we have the lithium that goes into the batteries, which is effectively there's no replacement in the foreseeable future for that. And we have the permanent magnets in the motors. So if you take all of those together, they've been roughly assessed by WH Ireland, who are our brokers, in consortium of around 42 million. They have the potential to create value for Cadence, if all goes well, to around 42 million pounds.
Wow. Okay. So, and of course that's not counting Amapa. So onto Amapa then. The iron ore mine in northeastern Brazil. It was a real coup for Cadence and your management team to secure that. You've crossed all the hurdles, well, most of the hurdles in regard to permissions to use the railway, ship the 1.4 million tons of iron ore from the port, and you also this morning announced a further £650,000 raise for a scoping study. So looking ahead, where do you see the value inflection points arriving for Amapa?
I think the inflection points are pretty simple. Once we start shipping the iron ore, that's I think once we've proven that we can do it. The next one will be the settlement with the banks, because one of the, as you said, not all the hurdles are being crossed, but one of them would to get a settlement with the secured creditors, which are the bank creditors. And once that's done, then we're free to really develop this mine at a much faster pace. After that, once we've got the settlement with the bank creditors, the shipment of the iron ore, you're then, looking at commissioning the scoping studies, or commissioning the commissioning studies, which are the sort of bankable feasibility level studies. And then it's going to be steady progress as we go out to production by the end of 2022. I think the most, and if you put a slide up there, is actually to show, its location. But one of the most important things about this asset, it's an integrated asset. So often iron ore assets or bulk material assets, they can be isolated, they can be stranded, they become reliant on a third-party railway, a third-party port, which you can then be beholden to pricing. While we, in this asset, once we get our investment in there, will have, it's a mine that's integrated with its own railway, its own private port. Those resources on their own are, worth a lot. And so I think having that integration, having control of that, means that we have huge cost savings, and then put us in a reasonable cost bracket in terms of the overall cost structure comparative to assets of similar size. So for us, value creation is going to be, is going to be consistent as we see the iron ore being shipped, that being invested in the asset, commissioning studies ongoing. Of course, as you mentioned, the scoping study, which we'll be able to publish to the market, and and going through the feasibility studies and then production. Okay,
so we have some more information on Amapa here. Just looking at the details and the processing plant and so on. Can you just run us through this quickly, Kiran?
Yeah, absolutely. So this is a nice overview. It's showing that it's a simple open pit mining process. It's showing that it's an existing processing infrastructure. It's got a low cost, it's a high quality product. This product's been sold. We're going to be producing 65%, with the majority 4.4 million tons at 65% Fe, which commands a premium of about $10 to the market. And its location, will be shipping majority to China. Now, and you can see also there what we're talking about, eventual product fee, about 5.3 million tons. Our costs will be around $23 a ton, including GA. So that's the OPEX, and not including shipping, of course. And then talks about the recommissioning costs overall, which is around $168 million estimated at the moment. I think it's important to put this in context of developing another iron ore asset or any other asset. When you're talking about an iron ore asset this size, you've got a huge infrastructure. Will cost you 600 million to develop. So by taking this asset this early, we're mitigating a lot of the financial risk. And through our structures in terms of how we invest, we mitigate the large part of the regulatory risk and the technical risk. As you see, we've got already a historically operating mine with a known resource, has to be updated. So all of those risks that typically associated with developing a mineral resource are substantially mitigated through our investment and through the asset. And I add that there's like up to about $30 to $40 million net of iron ore of stockpile sitting there, which further mitigates the need for us to raise capital in the market, or the asset to raise capital in the market.
That's excellent. That's a great structure as well, really. I think to bring an asset into the company that has all of those different elements it's a pretty rare find. Can you just talk us through the commissioning timeline here, Kiran?
Yeah, absolutely. So I think one of the things that we've been showing is that we've been achieving our preconditions, and as you can see from there, it says the first thing we need to satisfy the preconditions. As we've said, you said we crossed majority of the hurdles. One is to get the bank. The last ones are really to get the banks their agreement on a settlement agreement. Then our next tranche of investment, which will be another effectively 3.5 million. Will be once we get all the mining licenses and all the operating licenses, and we expect that to occur during this financial year. During this financial year, and we'll start our commissioning studies also during this financial year. Iron ore shipments will start during financial year, and it's sort of, you can see that lanes are partly greyed out. It's really depending on how quickly we can get them out. As I said beforehand, you would be on the positives, on the upside during this period, you'd be getting 3 vessels out every 2 months, and on the conservative side, 2 vessels out every 2 months. So that goes out to 2022. The revenue from that, or the net revenue from that iron ore stockpile, gets reinvested into the asset towards that $168 million worth of capex. Then we'll be looking for project funding on or around 2021 of 24 million. That'll be project equity. Now that can be a new partner going into the asset at the asset level. So we'd still have our 27%. Or of course, we could go up to 49%. It really depends on the economics. The great thing is we have choices here. And then you'd look for 140 to 150 million worth of debt financing, which would, fund the recommissioning that would occur during 2021. And depending on that timeline, again, I've left it grayed out slightly there. We'd look for production at the tail end of 2022, or new production from the mine. But all this time, we'll be generating revenue from the iron ore shipment, and it's important to note that.
Super. Okay, and obviously we're emerging now from the other side of COVID-19, and there's a clear set of value inflection points arriving there for Cadence Minerals. So just moving on now, we have some questions from shareholders that we've been collecting over the past couple of weeks. If I can just take you through some of these, Kiran, perhaps we can just have a look. I'll read them out, and then we can perhaps you can reply to them.
Yeah, absolutely.
So the first one, regarding Amapa, once the railway's been refurbished, can we expect an income from third parties wanting to access the port? I believe shipping costs around $10 per tonne, providing an income of around 57 million. Is that enough to pay for the railway refurb? Well, no, easily enough to pay for the railway refurbishment?
So yeah, I think the first point there is, will we be generating income from the railway? And the answer is simply yes, although that will only occur after our prioritisation of our iron ore. So, you know, one of the grants when we got the effective railway license, there is part of a community and social development program there, which we, for example, have to provide some passenger railway services, and there are other iron ore assets and other mineral assets along the railway, and of course possible of agriculture. So once we have spare capacity, we will definitely be utilizing that railway and generating revenue from that railway at commercial rates. So that will be after we've started production, and because we don't know where those commercial rates will be and what products we'll be able to ship in terms of spare capacity, none of that revenue stroke costs associated with any, you know, utilizing that railway, or even of course the port if you had spare capacity, have been included in our analysis of EBITDAs and so on and so forth.
Okay.
You know, the railway is around $29-30 million to refurbish. And yes, if we were able to charge own rates, then it would be sufficient. But bear in mind that will occur after we focus on delivering the best value, which for us is shipping our iron ore.
Understood. Okay. So second question, looking forward to beyond the start of ore production and with Cadence beginning to earn income from the Amapa project, are you likely to use the funds to help fund your other assets such as Cinovec, your joint venture areas that you discussed, lithium assets in Australia? Of course, those are going to cost many millions of dollars to fund. So will you use Amapa money for that?
I think we've always taken the philosophy that we will put the money where it generates the most return. And if those assets are sufficiently advanced and we envision them take sort of levels of return that we'd expect, then yes, we would fund them. But that's not to predicate the fact that we could find another asset and use the returns from Amapa to invest in that asset, or alternatively, for example, look elsewhere in the Amapa province, and if there are other assets there that we would look to invest in those, or increase the capacity in the railway, or increase the capacity in the port to utilize that as other revenue streams. So, you know, we will always focus on trying to get the biggest bang for our buck going forward, and that's always been our attempt, and that's what we will continue to do. So it could include current assets or new assets. Okay.
So third question, are you planning to use the port of Santana to ship the iron ore stockpiles rather than Amapa's own port?
So initially, as if anyone's read a bit about the history of the asset, there was a port collapse in 2013 while it was still under the ownership technically of an Anglo-American. That effectively ceased operations, and you know it still was profitable, or just about profitable, and it accumulated all these iron ore stockpiles, which is what the port collapse let us accumulate that iron ore stockpiles. So while that port has been rehabilitated, i.e. during that phase of rehabilitation and recommissioning, we will be using the local Santana port. And as that port becomes more rehabilitated, or we can get some more facilities there, we will start to using our port as much as possible. But initially it's going to be Santana port. And of course, we want to use our port because then we can start shipping 5.3 million tons a year, rather than, you know, in the order of, you know, 90,000 to 135,000 tons every 2 months, which the Amapa port has in terms of capacity for us. So it is important to get our port going, but that's really only going to occur once we've made the capital investment. So initially Santana port, eventually our own port.
Okay. So next question, you mentioned recently that we should regard Cadence as more of a private equity company. Can you elaborate, or can you explain what you mean by that, Kiran?
Yeah, absolutely. So historically, we've invested large stakes in public companies. So, for example, we still have a 16% in European Metals Holdings, which has served us well and given us returns on good returns on that. But I think what we've realised is that, as I've said beforehand, we want to become more masters of our own destiny and not reliant. As a non-executive, I can't make executive decisions, and there are conflicts that I can't be involved in between EMH and Cadence if there were ones that I couldn't be involved in. Being private equity, first of all, you're funding an asset that is not in the public markets, which is classic definition of private equity. But there are additional things. As a shareholder in a private company, we can have different shareholders can have different rights, while in a public company you can't. So we can put negative control, we can have certain levels of executive representation on the board. So it allows us more flexibility, takes us more control, and becomes more master of our own destiny. And that is one of the reasons that we go down the private equity route. So it's allowing us to take more of an active stake in the way that we operate. And there are other private equity aspects to our investment structure that, in terms of our JVs, that exist as well, which is similar to private equity.
Okay, thanks, Kiran. Okay, so just going through these last three questions now. WH Ireland, somebody's obviously received the note from WH Ireland here. They place unrisked values on Cadence shares of joint ventures, Sonora 21.5 million, Yangibana 12 million. What rights does Cadence have that will enable it to achieve those values? And the guy says, or the lady says, I find it difficult to believe that Cadence would have entered into joint ventures without some way of realizing value.
Okay, so each joint venture is different, and it will be dependent on the negotiation at the time. So this was before my time in joining Cadence. So in relation to those JVs specifically, there are drag-along rights and tag-along rights. So effectively, if they find a buyer, they have the right to, then that buyer has to be offered to us, and if we decide to sell, we can sell with that. So that's in the shorter or medium term, or whatever that may be, we can exit through that manner. The JV at Hastings, one of the advantages of it is that we haven't had to contribute nothing. So when you give away that, you don't have to contribute anything up to bankable feasibility studies apart from initial purchase price, you lose some rights. But ultimately, those two ways is that if they get bought out by the primary operator, there is usually an opportunity to sell out through that methodology. And of course, then the value through it as well is through dividends. So if those companies, assuming they come to profitability, et cetera, you will get a dividend share from that, proportionate to your percentage stake in it. So those are the two ways that we can get value out of it. Longer term is dividends, shorter term is any possible sale that they may be of the asset, or even the sale might occur after dividends. But really those are the two, and they're very typical. And each JV will be different. And we do have clauses in there to allow us to create value in that way. Okay.
Second last question. Could you say something about the prospects for Macarthur Minerals and lithium investments in Australia, please?
Yeah, so Macarthur Minerals, of course, they are farming out certain parts of their other assets, their lithium and their gold assets, and their base metal assets rather. Our focus is now really on their iron ore assets, because that is embarking on the bankable feasibility study. They have Glencore as a partner there, as a life of mine offtake and funder there. So that's really important and attractive to us. And we'll see how that moves forward. I think off the top of my head, their last NPV valuation on their bankable was in the couple of $100 million for the asset. So let's see how that progresses. But again, all of our assets are, predominantly are at the bankable feasibility or de-risked stage of investment. Yeah. So in terms of the other Australian lithium assets, so as you remember, we basically through Argentina, we were finding that the government was taking long to grant certain licenses. So we effectively said, well, come on, guys, you need to give us something more. So we've got these Australian assets on top of it, within the same agreement for no extra consideration. We've done some exploration. We updated it earlier in the year. In fact, last year, updated what that was. I think the most important thing is that we actually see, in terms of our investment philosophy right now, putting money into, although those results are interesting and promising, we'd rather put our money into Amapa, because we're likely to get a better and quicker return than in Lithium Australia and Lithium Technologies at this point in time.
Okay. Final question. Presumably funds will have to be raised to make further investments into Amapa. Obviously, we've seen the raise today. Will these come from farming deals? How else will you raise the money?
So I think, it's really important to understand that the way that we structure this, the first 20%, we've already raised the money at 2.5 million. That is sitting in escrow. And once we get the banks done, we will then get our 20%. The next tranche is 3.5 million to go to 27%. I personally think that we will do that ourselves because I think not unless there's something horrible happens with iron ore price or there's something drastic happens with the project. Where the project stands now, there's considerable value in investing that money and getting up to 27%. And we'll look at which way is the best way to do that. Whether it be through equity, through debt, through mezzanine finance, it really depends on which is going to deliver the best value to our shareholders. So we will be definitely getting up to our 27%. I'd like to add that some of the expenditure that we've already incurred to that will incurred in Amapa on behalf of Dev will actually be, or part of the JV will be credited towards that 3.5 million. So I don't expect it to be the full 3.5 million. As to the next stages, going up to 49%, well, we'll have to wait and see where the project goes up to.
Right. Okay. Well, Kiran, it's been great talking to you. Fascinating finding out more about the Amapa project. Before we go, can you give 3 takeaway points for investors considering putting money into Cadence Minerals?
I think the takeaway points for investors is that they've got to look at our underlying asset base. Our lithium assets and our investments in lithium, rare earth minerals, and other iron ore assets, not including Amapa, as we've highlighted. WH Ireland independently, well, they're a broker to the company, have put a considerable value over the current market cap on that. We also have our prospects in Amapa, which, if we talk about this asset was worth, a devalued and impaired value. It was worth 600 million under Anglo-American days. We certainly hope that we're able to achieve sort of those levels of valuation once we get this back into production. So I think for Cadence, there is both an already, there's several suite of assets there that either all of them or some of them could provide substantial upside for Cadence going forward.
Kiran Morzaria, Chief Executive of Cadence Minerals, thank you for joining us today.
Thank you very much, Alan.